Now, still in China, the country is considering a proposal to have local governments across the country buy millions of unsold homes in what would be one of its most ambitious attempts yet to salvage the beleaguered property market. The State Council is seeking feedback from several provinces and government entities on the preliminary plan. Over in Europe, inflation in the Eurozone is set to drop faster than previously expected this year, according to updated EU estimates. The European Commission on Wednesday said annual inflation in the single currency bloc is set to drop to 2.5% this year before reaching European Central Bank's 2% target in the second half of 2025. In its previous forecast in February, the Commission projected a more gradual decrease to 2.7% in 2024 and 2.2% next year. Still on inflation, in the United States, the Consumer Price Index cooled slightly in April after three elevated readings. Consumer prices rose by 0.3% from March to April, the Labor Department said on Wednesday, and down slightly from 0.4% the previous month. Measured year over year, inflation ticked down from 3.5% to 3.4%. And a gauge of underlying inflation, which excludes volatile food and energy costs, reached its lowest level in 3 years. Efosa Aluyi, who is head of investment at Sankore Global Investments, joins us now to discuss this further. Efosa, good morning to you. It's a pleasure to have you on Global Business Report.
Good morning. Thanks for having me.
Now, we saw U.S. stocks rally at this latest inflation print. How would you interpret this latest CPI figures?
I mean, I think the weaker than expected CPI number, coupled with the retail sales number as well that we saw yesterday. I mean, month-on-month CPI came in at 0.3%. The market had expected a print of 0.4%. And this translated into a year-on-year print of 3.4% as against the previous print that we saw at 3.5%. So this weaker than expected number, coupled with the retail sales number that was essentially flat, right? The market was expecting a 0.4% jump in retail sales. So all of these essentially allude to the fact that, the disinflationary trend that we had seen towards the end of last year is sort of continuing. And on the back of that, we saw U.S. stocks really rally. I mean, the S&P was up about 1.17%, crossing the 5,300 mark for the first time. Important to also note that this was its 23rd record close this year. It's been a very, very strong year. If you look at the NASDAQ as well, it closed about 1.42%. Its 8th record close this year. The Dow Jones Industrial Average was up 88 basis points. Its 18th record close this year. So, the weaker than expected print has proven very significantly positive for the market. If you even look at the Treasury market as well, we saw the 2-year and the 10-year Treasury yields declined by 10 and 9 basis points respectively to about 4.34 and 4.72. So overall, this number provided what I'll call positive sentiment for the market. If you even look at the Fed funds futures, it's now pricing in a 75.3% chance of a rate cut in September. If you looked at that number on Tuesday, it was 65.1. So it tells you that this, weaker than expected inflation or CPI print, coupled with the weaker than expected retail sales print, has provided very significant, positive sentiments, for the market, really.
And like you said, there's been strong performance for a while, so there's a bit of leeway there. But how do you suppose Jerome Powell and the U.S. Fed will review these numbers? And does it mean anything for U.S. monetary policy?
Yeah, so I think, Chairman J. Powell has really reiterated the fact that they will continue to look at the data. And I think this is just one data point yet, right? If you look at that, inflation year-on-year number, it's still higher than the 1-year average. It's still higher than the year-to-date average, so it's just one, data point really. And they've actually reiterated the fact that they will need, a couple of months of sustainable disinflationary trend, for the Fed to actually move. So I don't think that it changes anything significantly. I think the market reaction is, something that the market really had been looking forward to, right? It was basically what the market wanted to see, and it played into what the market, wanted, but in terms of monetary policy, this is just one data point. We will need to see inflation for a couple more months. We need to see job numbers for a couple more months for us to get to the point where we, are sure that the Federal Reserve will begin to start to cut. But I think another positive thing is the fact that the Fed had hinted at the fact that, a rate hike really wasn't on the cards at this time. So that continues to provide, positive support for broader market momentum, really.
So a bit more monitoring before we have any sort of certainty as to what the direction is. Well, across the pond in Europe, we've seen the EU Commission now review downwards its inflation forecast for this year and the next year. What are the triggers here?
I mean, I think that on the inflation front, the EU has probably fared better than what we've seen in the US. You know, the impact of, you know, the Red Sea trade route closure has been significantly milder than had been anticipated, and that has even led to a decrease in the cost of food and other items that, the European Commission had expected would, grow quite significantly. So on the back of that, there have been these revisions that have seen, inflation expectation dialed back. The expectation was that we'll see inflation, close this year at 2.7%. That has been revised down to 2.5%, and that in 2025, we're going to see, inflation hit the ECB mark around 2%. And this just continues to support, the narrative of, the ECB actually moving first or moving before the Fed to normalize or to cut, interest rates.
Right, but talking about the ECB, like the U.S. Fed, what does this review then mean for Christine Lagarde and the rate path for the ECB?
I mean, I think it provides more impetus for the ECB really to be on that path to cut, which they had essentially been on, if you will, over the last couple of months, really. So, I mean, this further downward revision, in the CPI expectation just gives further impetus to the ECB to, pretty much normalize or cut interest rates, as we see it.
Okay, that's quite an outlook on it, which is fair enough. Now, back to the U.S. and let's look at this Biden tariffs. Do you believe that the 100% is a bit excessive? How do you view those hikes?
I mean, I think these are largely protectionist moves that would at best delay, the influx of Chinese EVs into the U.S. market. It would at best delay it. I don't think it would prevent it. I think, the U.S. government right now is reacting to and trying to claw back really a lot of lost time, if you will. If you recall, the Inflation Reduction Act really is at the heart of this, where, you are looking at a lot of grants to EVs and, clean technology in the U.S. However, if you look at what has happened in China over the last couple of years, there's been very heavy subsidies going towards EV producers in China that, the U.S. is fearing will lead to overcapacity and could then lead to dumping. But nevertheless, I think these are, largely, protectionist moves. I don't think it would prevent those Chinese EVs from coming into the US. For instance, and I think that they could be potentially inflationary. The only challenge there really is that, these tariffs apply to just only about 18 billion worth of goods. In 2023, imports from China into the US was about 427 billion. So this is just about slightly above 4%, really. So the impact of which I don't expect to be, really, really significant. But then if you look at, BYD, for instance, it's an EV player in China. It has this small EV called the Seagull. It costs about $10,000, right? With 100% tariff, right? That EV still appears from a price point much more competitive than most of the EVs in America. So I don't know that it significantly changes, anything really, but I think these are, largely symbolic moves that are, largely protectionist. And, I don't think that it changes anything, significantly.
Right. I mean, it's about national interests first, right? But,
absolutely.
China is kicking back and not taking this news, very likely, but they haven't also revealed any sort of retaliatory, plans or moves yet. Do you believe this is inflammatory enough? I'm talking with regards to the 100% tariff. Is this inflammatory enough to lead to some sort of trade war like we had with the Trump administration?
I don't think that we would necessarily have a trade war, as the case may be. But I think that it is only expected that China will certainly kick and sort of react to this. Like I said, it's really a small portion of, the trade between the US and China. But again, it is also very symbolic. So you would expect that China would certainly react to this. It really remains to be seen what retaliatory moves China would make. But I think that what the US is really trying to do is to, protect its own EV industry. But I think overall, this might not necessarily bode well for, the global clean energy agenda at the end of the day, because it tends to distort and limit, fair competition, if you will. So I think those are some of the key challenges that we kind of need to grapple with going forward.
Does China have a right to retaliate? I mean, from a protectionist point of view, I would expect that it's something that would equally affect the U.S. in terms of trade, right? What do you see any of that being on the horizon?
Yeah, I mean, they absolutely have the right to retaliate, but I think the critical question is really, how do you retaliate, right? What do you do exactly? Yeah. If you look at U.S. Exports to China, they're just slightly under $150 billion, right? And a lot of it is largely agricultural produce. So where do you retaliate? And these are things that China really does need. So where do you retaliate? Again, if you look at what has been happening there's a lot of Chinese capacity that has been ramped up in Mexico, right? So what's happening, this tariff really is targeting products that are coming in from China. It doesn't say anything about products that are coming in from elsewhere that are Chinese products. So you could still see a lot of those Chinese products flow through the US from Mexico because there's a lot of Chinese capacity that's been built up just south of the US border. So that's another thing to grapple with at the end of the day.
But what are the immediate effects of this for consumers within these markets?
Right, like I said, it portends to be inflationary, right? So there is that impact there. But again, if you look at the overall picture, this portion is really small in terms of the overall export, from China into the United States.
All right, in wrapping up very briefly, please, still on China, what do you make of the consideration to purchase unsold homes by local government?
I mean, I think it's another move again by China to kind of try and deal with this beleaguered property sector. Home sales plunged 47% in the first 4 months of this year. Unsold inventories sit pretty much at about an 8-year high. China has tried to do this before with, not much success really. And the idea really is to have state-owned enterprises and local governments buy these homes. However, if you look at the state of these state-owned enterprises and local government, they are really bogged down with a lot of debt. At the end of 2022, corporate debt in China was about 29 trillion. That's pretty much the same debts of the United States as at that period. So the leeway or the room for these state-owned enterprises to sort of maneuver and buy up these properties, it seems very limited. However, China is currently looking to issue an ultra-long bond, 1 trillion yuan, about $138 billion, tenor ranging from between 20 and 50 years. I understand that the first issue will come out tomorrow. So maybe this will form part of the funding for that, remains to be seen. But again, there are estimates that say China requires about 7 trillion yuan to take care of this property issue. So again, it's a lot. And these are steps that I believe that ultimately might be able to take care of the problem, but it really does remain to be seen.
Absolutely. Well, it's certainly been an eventful week already so far.
Absolutely.
We just have to wait and see how things unfold. Efosa, many thanks for being on the Global Business Report this morning.